Hello and welcome to our key transaction considerations in the women's health webinar. Appreciate you joining us today. My name is Scott Davis and I'm a director at Provident Healthcare Partners. I'm joined by a terrific set of panelists here today with extensive experience in the women's health transaction space, eager to get their perspective on our topics. Generally speaking, we're going to be talking through a wide range of discussion points, including considerations from a pre-transaction status point, considerations on a post-close consideration point, as well as structuring and other points throughout that given transaction process. Again, my name is Scott Davis. I'm with Provident Healthcare Partners. Provident is a lower middle market focused investment bank. As evidenced by our name, we focus exclusively on the healthcare services space. We have a particularly strong track record in the physician practice management realm, having done over 75 transactions in that subsector. We have very strong dedicated efforts in women's health, including a number of subsectors off of it. I'm joined from my firm today by AJ, who is also with the firm, and Jake Vesely, who's an associate. For third-party guests here today, we have Andrea Ballo, who is Division President and General Counsel at Women's Health USA. Hi, Andrea. Thanks for joining.
Thanks for having me. I'm really excited to have this conversation today.
And also joining us is Justin Aiello, who's a partner at the law firm McDermott, Will & Emery.
Thanks, Scott.
And Andrea, maybe just off the top, if you wouldn't mind telling us a little bit about your firm and where you focus efforts.
Sure. So good afternoon, everybody. It's really nice to be here today. I am, as Scott indicated, one of the division presidents for Women's Health USA. I focus on our Western market. Women's Health USA and its parent company, Unified Women's Healthcare. We are a management and capital partner to affiliated women's health practices around the country. We are currently in 19 states with over 2,500 providers that are part of our family. And what we're really here to do is to preserve the independent practice of medicine in the women's health space. We are the largest single specialty group in the country. And we are looking to grow and really to provide opportunities for physicians to remain independent. Our hypothesis is that physicians are happiest in an independent practice setting, both older and younger physicians, and we're looking to create opportunities for our practices to continue to grow and to build their legacy in their chosen markets. So what we're trying to do is really enhance and provide support for them on all of their business endeavors, whether it is day-to-day just getting their claims paid or more strategic opportunities looking to build out their ancillary services. We believe that our model allows physicians to do what they do best, which is see patients, but also have an opportunity to grow their own wealth, improve their quality as part of a national platform.
Thanks, Andrea. And Justin, a little bit of color on your firm and where you're focusing efforts.
Absolutely. I'm a partner at McDermott, Will & Emery. I'm in the Miami office. McDermott's a full-service law firm with over 1,000 attorneys around the world, and probably someone that specializes in every single area of the law. I focus on healthcare, specifically PPM transactions, which are physician practice management transactions, and ambulatory surgery center transactions. And like my colleagues, I represent clients all across the country.
Thanks, guys. And with that, why don't we just jump right into the content here. To set things up, AJ, I'll steer to you first. Just a little bit of commentary on the overall trends we've seen within the consolidation of women's health. It's obviously been taking place for a number of years here, but I certainly think we're seeing things evolve more and more as time goes on. Your perspective on that would be helpful.
Thanks, Scott. Happy to kick things off. And I'll try to focus my answer on especially the OBGYN transaction activity we've been seeing. As I know, we'll have some additional comments from Andrea and Jake a little bit later on some of the subspecialties of women's health outside of OBGYN that we're seeing consolidation in as well. But Scott, to your point, there's been consolidation in PE investment activity happening within OBGYN for a number of years now. It really kicked off in 2013 when Ares Management, which is a significant private equity player in the healthcare arena, invested into Unified Women's Health, which at that point was a management services organization on behalf of women's health practices. In addition, closely thereafter, they invested into OB Hospitalist Group, which did more laborist type services on behalf of hospital systems across the country. Really for us at Provident, that drew our attention when a group as large as Ares was making two bets on women's health in a very short period of time. We thought that would kick off additional interest and activity from other private equity investors, especially in the women's health space. And that really played out over the next few years when I think 2017 was certainly a watershed moment. For us at Provident, we represented Women's Healthcare Group of Pennsylvania. They were recapitalized by Audax Group and concurrently merged with Regional Women's Health in New Jersey to create the Axia platform. Within the same calendar year, Andrea and her colleagues at Women's Health USA went through their recapitalization with Verica Capital. And we also saw Lindsay Goldberg invest into Women's Care Florida, now known as Women's Care Enterprises, in 2017. So there was certainly a flurry of activity that year, and that was kind of representative of not only just burgeoning interest within physician practice management, but a lot of specific attention into opportunities in women's health as well. And I think over the next few years, there were certainly other platforms created that have made some significant headwinds into the space. Groups like Advantia Women's Health, Hero Women's Health that was recently formed, Shore Capital making two investments into the women's health space as well. But really the preponderance of activity from, call it 2017 till about 2020, 2021, was related to a significant kind of regional partnership and bolt-on strategy by those existing PE-backed players. And those proved to be highly successful for us at Provident. We had a chance to work alongside Andrea and her team, representing a group in Massachusetts that was ultimately part of Women's Health USA. Also represented a group in the Ohio market, Seven Hills Women's Health, through their acquisition by Axia, and a few transactions with Unified as well along those lines. But really kind of the consolidation strategy was, blessed, if you will, by the second iteration of private equity investors into women's health, which we saw happen in 2020 and 2021, with Unified going through their secondary transaction with Altus, Axia being recapped a second time by Partners Group, Women's Health USA having a successful transaction with Unified, and BC Partners investing into Women's Care Enterprises. And so I think what we anticipate, for the years to come is certainly more opportunities for new private equity investors into the space, but also continued inroads by some of the groups who already have a significant thesis in the space, have private equity backing, and have significant case studies showing kind of the strength of their models in, creating great outcomes for the patients, the payers, and the providers in the market.
Yeah, that's super helpful. And obviously with all that traction, there's a clear, investment thesis that a number of different folks have really gotten on board for. What would you say are some of the key drivers behind that that's, led to the amount of consolidation that's happened thus far?
Absolutely. So I think there's significant demand drivers for the provision of care within women's health, specifically OBGYN. You can point to certainly macroeconomic and demographic trends, such as the increasing female population in the United States. I think a broader need for services in light of those population dynamics, whether it be increased incidence of GYN cancers, awareness of pelvic floor disorders, and the need for services there. I think also just socioculturally increased age of childbearing, which could lead to complications in pregnancies, and also need for fertility and MFM services. Certainly awareness of breast health as well, and increased utilization of mammography. But I think what we're seeing complementing that demand driver from the population is also significant payer support for maternity-related services, GYN services, and I think an interesting kind of crossover with value-based care opportunities as well. That's become, Andrea, I'm sure you can comment, a key thesis as part of your growth strategy. But really all of those demand drivers, I think, are also complemented by a practice need for consolidation at the same time. just the nature of OB work, the overnight calls, et cetera, can be taxing on physicians. I think the days of your kind of neighborhood OBGYN that does all of the deliveries at night and all of the patient visits during the day is certainly kind of history at this point. And there's been a need to grow staffing capabilities, create economies of scale with respect to malpractice premiums. And lastly, just similar themes for other physician practice management areas, whether it be a need for investment in technology, data, revenue cycle, but also needing to gain clout opposite health systems who are continuing to gain scale, as well as payers. So I think just the confluence between the demand side drivers for kind of growth within the industry, but also a need for consolidation to address that has definitely driven a lot of consolidation to date. Andrea, would love to hear kind of your perspectives as well, being an operator in the sector, to see how things may have played out from your perspective as well.
Yeah, it's interesting, AJ, as you were talking about the payers. I can remember a conversation I had back in 2013 with one of the large health plans, and we were talking about a closer alignment and the importance of women's health providers in their network and what we might be able to do together, to align more closely. And they said to us, but why should we care about that? It's like 5% of our spend is OB. And, that was 2013, so not even 10 years ago. I think what health plans and others are really coming around to is the notion that women are the drivers, not of 5% of your spend, but really of 80% of the spend. I am making decisions on behalf of myself, my husband, my 2 children. I help my parents make decisions. When my in-laws were alive, I helped them make decisions. Women are really the head of the household. And, if you're looking for who drives spend, it's women. And if you can create an organization to do all of the things that you said and really create a sustainable model for the practice of obstetrics and gynecology, but really broadening that to the field of women's health. And you can bring providers together to provide a very differentiated experience for the woman. It will really help. That's really, I think, where the future is going. And particularly when you talk about value-based care models, we've got to align. We've got to align with payers. We've got to align with hospital systems. We need our providers in alignment. We've got to create opportunities, not just for our older physicians, but also for younger physicians to find a home with us and grow with us. And you can't do that in a smaller practice any longer. You can't get the audience with a payer to have these conversations. You just can't think broadly about these topics in a small organization. And I think that is what women's health as an investment opportunity represents to those that are looking at the industry. It's really an opportunity to harness the dollar in this, but also to create, at least in our world, to create something fundamentally different for our patients and the families that they care for.
Yeah, Andrea, and as you develop a platform that really seeks to capitalize on value-based care contracting, obviously that's going to require expansion of, sector focus and specialty focus. Where have you all spent time in order to do that, whether it be, hiring additional providers or maybe even acquiring practices of subspecialty focus?
So we've looked, we've started with the close-in subspecialties. We've got some significant investment out west in maternal fetal medicine. They really are the next closest in specialty, and there's incredible, clinical synergy between the OB and the MFM, which is doing, the higher risk patients in our network. I think we've looked at urogynecology, but I think that we've looked at GYN oncology, breast oncology, made some investments in urogyn, not as much in the oncology space, but I think there is natural opportunity for that if we can build out our investment hypothesis a little further. But I think, even further than that, I'd like to see us longer term move into things like endocrinology around diabetes and thyroid disease. Bring in a women's focused cardiologist into our practice, move further into primary care. At my age, I'm seeing my GYN once a year for an annual, but I really love to check my cholesterol, make sure my blood pressure is good, and get myself a one-stop shop visit, as opposed to, all right, well, now I got to go find a primary care specialist and do all of those things. Women are driving doctors to do more and driving our physicians to think more broadly about their healthcare needs. And we are looking to, build out our practice to match the needs of our patients. And I think that's where you will see us not form a multi-specialty group, but to form a group of women's health specialists, women's focused specialists on women's issues that, as we get older, really do push into, even things like gastroenterology. That's where, my head as a parent of adult children is right now. I'm no longer, having babies anymore, but I still have medical needs that push well beyond what my OB does. And I want to be able to say to, I'd love to stay in my own system to be able to do that. My OB, my GYN is my trusted confidant. The worst thing about, ever relocating, I moved from Connecticut to Arizona, was actually having to give up my GYN and find somebody else. But wonderfully, I could find someone in our own network. And that's really what we're trying to create nationwide. And I think bringing in subspecialists with a women's health focus will only enhance our practice and enhance the opportunity for our patients to stay within our system.
That's helpful. And as you mentioned off the top there, I think the logical move is to kind of move in concentric circles from the core OB-GYN side. And most of the topics you mentioned are exactly that. Elsewhere, for Provident, we're looking at other sectors that maybe are a bit more tangential, as well as the ones you mentioned. Jake on the line with us was spearheading some of our efforts. So, Jake, if you wouldn't mind touching on those areas as well, I think it'd be helpful for the listeners.
Yeah, of course. And it looks like my video cut out, so trying to get that resolved. But thanks, Scott. Yeah, I would say that, Andrea kind of hit on some of them with the maternal fetal medicine, but, we're starting to see just a broader interest in the subspecialized verticals of women's health and the ancillary opportunities, such as things like mammography or MFM and fertility. Especially on the fertility side, groups are looking to expand into some of the ancillary opportunities like surrogacy and matching and egg bank services. Not only are these subverticals within the broader women's health space experiencing a lot of the same favorable demographic trends, such as the ones that AJ alluded to, but they also complement the theme of healthcare providers really striving to provide a full suite of services to their patients, especially as we transition to more towards bundled payments or a value-based care environment. Having these subspecialized capabilities will be even more important. Just as an example on the fertility side, about 2 years ago, we saw Webster Equity Partners acquire Newborn Advantage Surrogacy to complement their existing IVF platform. And we've heard of several other IVF platforms that are seeking similar acquisitions as well. On the OB side, we've seen a lot of interest in expanding on the mammography portion of their business. We've seen interest in M&A activity in that sector dating back to 2015 when Solus Mammography was acquired by Audax and Frazier, and subsequently going through a secondary transaction with Ares in 2018. And then on the MFM side, this is really an area where the U.S. is experiencing a healthcare crisis, and we're lagging significantly behind other developed countries regarding things like the maternal mortality ratio. And there's a growing pressure to improve outcomes in this regard. And I think investors are certainly taking interest as well. Andrea mentioned the deal they did with Desert Perinatal Associates, and we've heard of several others that are potentially exploring the market. So I think this is an area where we'll start to see more M&A activity as well in the near future, and start to see additional investors come into the space and strategics expanding their existing platforms, with these capabilities.
Oh, I agree with you wholeheartedly, Jake. Infertility is a wonderful complement when you think about things. If you can envision a women's health medical home, as I think market is aware, Unified also acquired CCRM, which is a large national platform for infertility, headquartered out of Denver, Colorado. And that really speaks to the notion that, when a patient comes in, you don't know if, they have no issue getting pregnant, they will have a high risk pregnancy or they will have difficulty getting pregnant. And being able to provide patients with a pathway to one of our providers, regardless of the issue, really creates a feeling for the woman that they don't have to figure this out themselves. Healthcare generally is pretty disjointed. And what you find is, you've got to get the patient while they're in their office and make sure they get all the care that they need. You mentioned, Jake, also mammography, which is something that we built out in every one of our markets, not just because it's a wonderful ancillary revenue stream, but it ensures for our doctors that patients are doing what they need to do. What you find is if you hand them a referral slip, does the patient actually go and make the appointment? Do you end up with an entire 12-month period where, maybe they forget to get the mammo, and then, well, they haven't gotten their mammogram, so they're not going to schedule their annual. And then suddenly you're not seeing the patient for 15 to 18 months. But if we can build that out inside of either the four walls of one of our practice locations or in a very close by location, schedule that mammo and that annual visit at the same time, we are making sure that the patient isn't coordinating their own care, but we're coordinating the care for her in a way that meets all of her needs. Being able to pick up the phone and call over to one of our MFM practice and say, I'm seeing something that's making me nervous. I really want my patient to come over for a quick anatomical scan and take a look at what's going on. And having those providers have a strong collegial and family networked arrangement that they're working hand in glove from one another is what takes away the barriers that women have and what will make the healthcare system more effective. So I absolutely agree, Jake, with everything that you said.
Yeah, that's great. And I think, we've covered basically, social, economic, clinical rationales to what could be driving consolidation. But love to get Justin's perspective now from a more of a legal regulatory perspective as well, as that definitely plays a part here in the thought process.
Yeah, and that maybe not necessarily a regulatory change that drives consolidation, but a regulatory factor that does drive consolidation is compliance with the myriad and technical and complicated laws that govern all of these practices. And so, for example, if a practice wants to grow, the most obvious way is to get more patients, have more capable providers that can service those patients. But at some point, there's a limiter on how much you can grow in that manner. And one of the best ways to add growth to a practice is to drive or add all these ancillary revenue lines to the business. And so doing that is an obvious way for the business to grow, but the less obvious aspect of it is to ensure that you do it in a compliant manner. All these group practices that want to run ancillary profits through the practice have to comply with a law that I'm sure everyone's familiar with or has heard of, called the Stark Law. And I won't get any more in the weeds on that unless I bore everyone on this webinar. But it is absurdly technical and complex and nuanced, and not just any attorney can go, who doesn't necessarily practice in the area can go and read that law and understand how it applies and the operational and practical implications that stem from it. And so a lot of these private equity-backed sponsors work with large law firms that maybe are would be priced out for certain smaller independent practices, but when they bolt onto these large platforms, they get access to the counsel that deal with these laws every day, and will be able to give them the best advice concerning remaining compliant while capturing all those ancillary revenue lines. I guess
right. And
one other one, Scott, is not necessarily health specific, but obviously a driver of a lot of activity last year was the potential for cap gains increase, which didn't end up getting passed, but it's still not necessarily off the table. And I think that's going to be another driver for a lot of transactions this year, because until people know that cap gains increase is dead, people will want to ensure that if they're close to or thinking about a transaction, they'll want to ensure they get it done before that rate gets jacked up by 50 or 100%, which is a definite possibility. I think a lot of people don't think it's going to take effect until perhaps 2023. There's a minority view that there's a potential for retroactiveness. So it potentially could be too late already to get the deal done, but I think most people think 2023. And so I think we're going to have yet another very active year in light of that.
Yeah, and the topics you touch on are ones that, not the average physician is thinking about day to day. And when they come to their attention, they're probably not ones that they feel confident they can work through. And so I think that, coupled with the writing on the wall with consolidation that's taken place is really have a lot of these physician groups looking around, what are my options? Whether that be, staying private and going at it alone, joining with a private equity group and using their resources to combat these forces and try to grow, or someone more strategic, whether that's a hospital, health system, or some other form. And so, that's something we help groups here at Provident think through on the front end before process. And Jake, would love to get your perspective here on the different options that are out there and kind of how a prospective seller should think through those.
Yeah, of course. So when you think about M&A options, the first option for groups is simply just to stay independent. That said, I think independent practices are facing increasing amounts of threats each year in terms of groups really need to build more size and scale in order to meet regulatory threats and potential threats to revenue that are inevitably going to come down the line as we transition to value-based care and a host of other challenges. And as a result, I would say we're really seeing groups explore two main options, and that's either via a hospital or health system acquisition or merger, or going the private equity route. So the first one that I'll touch on is just partnering with a hospital or health system. Typically, this is the least attractive option for our clients, as this path offers the least amount of autonomy. It's usually a lower valuation than what our private equity peers are paying, and there's limited to no availability to participate in the upside. Doctors are either straight salary or comped on an RVU basis with no ability to participate in ancillary income or share in the profitability of the organization. So typically, this is the least attractive option for physicians. Because of this, many groups are exploring private equity as an alternative to remain independent. Critically, the difference between PE-backed enterprises and hospital-employed physicians is the fact that the folks that partner with private equity remain equity holders, which is really the key to remaining independent. So within private equity, there are a few options. The first is becoming the initial platform, and the second would be joining an existing private equity-backed platform, either as a regional platform or just as a partnership with a group that may already be in your geography. I think that when Provident is initially discussing opportunities with practices, most want to be the platform, so to speak, but there really are a limited number of groups that can truly qualify as a standalone platform. First, they need to have certain levels of revenue and profitability, as private equity firms have minimum equity check requirements for new platforms. These practices also must have made a significant investment in their infrastructure so that they can support future growth. And while PE can certainly make investments in infrastructure and back office, there needs to be a strong foundation in place to support the rapid growth of the business. For groups that do qualify as a platform, there are a lot of pros. There are some cons as well. When you're the initial platform, you're really helping determine the overall direction of the organization. You have a meaningful say in just about every decision of the practice. And with that comes a lot of expense and a lot of time having to think through, all these different issues and working with the private equity partner to determine the best game plan moving forward. That said, it does offer the highest potential upside as well. Typically you'll get the best economic and the best governance terms if you're the initial platform. You'll have the most control over, say, board seats compared to an add-on acquisition that's further down the road, who's going to have a very limited say in terms of the board or the overall direction of the platform. There is a bit of risk, though, in being the initial platform for these transactions, although I don't think it's particularly high anymore, especially in our processes where these practices are partnering with sophisticated private equity firms that have had success in other specialties and are just generally very knowledgeable about how these transactions work and how to build these platforms. We typically see these groups to go on to be very successful, but of course it is higher risk than just joining a platform that's been established for 4 or 5 years already. And then the next option within private equity would be joining an established private equity platform, whether that be as a regional platform or just as an add-on. So I think the regional platform play is a great option for those that don't want to join someone in their backyard, but may not have the size or scale to be a standalone platform on their own. In a regional platform, also practices are given certain autonomies within their particular region, which oftentimes they end up forming a regional MSO that sits under the national MSO, where they can have meaningful equity appreciation attributed to the direct growth of their region. So that's definitely an attractive option for groups in that situation. And then the last option in the PE universe would just be the standard partnership with a PE-backed organization or an add-on. This is a great option for smaller practices or those that simply think they would be more successful from partnering and gathering their forces with like-minded people rather than creating the platform from scratch. And the pros and cons of this last method are really the exact opposite of what we just discussed. When you're an add-on, there's a lower risk on the rollover equity portion, and oftentimes you can see meaningful appreciation in a shorter period of time, as the platform is likely a few years into their investment cycle and they're nearing their second bite or their exit. There's also less time and money involved, as you're essentially just getting plugged into an established organization. So there are a lot of pros of just joining forces with a larger platform as well. Andrea, I'm not sure if you have anything to add there or anything that you'd like to share from your experience in these sort of transactions.
Well, Jake, I'm sure you would not be shocked to hear me say I like your last two options the best, because those fit into our growth strategy. But I really do believe that there is value in speaking with established platforms, whether you can be what we would call an anchor in a new market for us. Even if you're, if we're opening a new territory, let's pick New Mexico. If you are doing that with an already established platform, it's a real plug and play for us. Once we bring the physicians together, we provide all of the support that is necessary to help with growth. We'll help with recruiting, and we help with hospital relationships, ancillary build out. It really becomes a great way to be the market leader in your market as part of a national platform. And to your point, to participate in, however we structure that second bite at the apple. It's a great way to be a platform really within a platform. We have a lot of respect and belief in market autonomy, and what works, in Las Vegas isn't a model that necessarily works in Texas. We might have something slightly different in Connecticut. Each one, when you're part of a national organization, we're able to bring learning from every part of our organization to say, in value-based care, episodic care, arrangements really work best, in some of our East Coast markets. That's really where the payers are, versus out West, where we may be looking at something, well down the line of capitation. We can bring all of that expertise, all of that business knowledge to a group in a new market for us, that gives them that platform opportunity and that autonomy that they're looking at, but in a well-supported environment. I think an environment where, we or one of our competitors might have a presence and you're a smaller practice, to us, this is a great way to, quote unquote, come in out of the cold. Let us help you. We can plug you in everything from, better revenue cycle management, more support on IT infrastructure. We spend a lot of time talking to each of our groups about how to protect their network better, EMR support with conversations with payers. And really, to me, when I talk to small practices, this is your moment to say, to take a breath and say, geez, this is wonderful. I am now well supported. I'm spending more time with my patients, less time, fighting with payers to get me paid, less time pulling records because they're doing, an authorization request on every claim that comes in. And I've gone back to practicing medicine. And I think for smaller groups, that's really what, the advantage of coming into an established group in the market. You're getting that equity opportunity, as you pointed to, whether it's a local or national opportunity. And you're really coming in out of the cold from trying to do it on your own and going back to your roots. And I think what a lot of our physicians say when they join our larger practices is, this is wonderful. I've really gone back to why I went to school. Why I went to school was to treat women, not to deal with, late claims payment or, 1-800 IT support. I want to spend time with my patients. I don't want to think about what practice management system I'm working in. So I think that, looking at an established platform to me is the preferred route. And I think for our physicians, if you juxtapose that against potentially, selling your practice to a hospital, we are actively, whether we're recruiting out or people are pushing their way into our practices saying, geez, I didn't go to school to help the hospital, become, a level 3 NICU certification. I didn't go to school to sit on a hospital administrative committee. I went to school to see patients. And I think that's what a larger independent platform offers. Hospitals certainly offer wonderful security, but I think if you're a younger physician and you're looking to grow your practice, looking to stay connected to your patients in a better supported environment, looking at one of the large platforms, it's either regional or national, is really going to be the best alternative for most physicians that we've talked to.
Okay, well, with everyone seemingly in agreement, the PE option is probably the more advantageous one, and probably the one that physician owners know the least about, understandably. I think it'd be good to spend some time on how those deals are structured from a number of different angles. Maybe just starting with what I'll call the financial implications in construction deals. If you give us a feel for some of those dynamics, that'd be helpful.
Absolutely. I think the way to think about the typical private equity transaction is with the goal of creating alignment between the existing shareholders, the physicians of the business, and the go-forward company/equity firm. And typically that's accomplished through structuring the enterprise value that a private equity firm would pay for a women's health practice as a mix of both cash proceeds at closing as well as rollover equity. And really how that's determined in terms of the enterprise value is to look at the adjusted EBITDA of the business. And we'll get into what that means throughout the conversation here today. But taking the adjusted EBITDA of the business times a multiple equals the enterprise value. And so with the mix of cash at close payable to the shareholders and, equity that's rolled over or held in the parent company going forward, there's a few different kind of implications there. I think one is there's certainly a bit of a tax arbitrage situation for the selling shareholders where you're able to essentially get X number of years of distributions payable at closing, which is generally taxed at capital gains rates, which are more advantageous, as Justin mentioned earlier, than ordinary income rates, which given the environment in 2021 and even what we're seeing in 22 has been a big reason for why we've seen so much deal activity specific to practice management and within women's health specifically. But even on kind of the rollover equity or the stock that's held in the parent company, there's typically the ability to defer the taxation on that until you sell that stock down the road. And really where the alignment comes into play is private equity firms generally have anywhere from, call it 3 years to maybe 7 or 8 years on the longer end of a runway where they look to be invested in any single portfolio company. There's certainly exceptions to that rule where you may have family offices, as an example, that have an indefinite hold period for their investments. But generally, private equity firms look to take a 3 to 7 year investment horizon and seek to increase the value of equity that they've invested anywhere from, call it 3 times to 5 times. Hopefully, the more the better for everybody involved. But the idea for physician shareholders is that they're kind of along for the ride with the growth of the overall business. So when the private equity firm looks to exit their holding and take some chips off the table, that's also an ability for the physician shareholders to similarly see a second liquidity event. And so, the typical structure and what we've seen played out in the women's health space so far, especially those groups who have aligned with the Unifieds of the world, the Axias of the world, Women's Care Enterprises, Women's Health USA, is that they not only got, cash proceeds at close for joining those businesses at the time of their initial deal, but they also saw the opportunity in 2020 and 2021 to take some of that stock that they've reinvested, realize the growth appreciation of it, take some additional chips off the table. And I know for several of our clients who have stayed, within those businesses after the second transaction, still having more opportunity for growth in the future. And so kind of taking this back just purely from an alignment standpoint and outcome standpoint to what Jake mentioned earlier, what we tend to see with groups that align with the private equity approach is that they like the opportunity of having these multiple liquidity events over the course of a career that may be, for some physicians that are especially on the younger end, might be 15, 20, 25 years or more. It's almost kind of an annuity stream for each time they go through a transaction versus, let's say, aligning with the hospital system, which more often than not equates to simply 100% exit, which might be, let's say, great for older physicians that are ready to retire, but creates some difficulties for someone who just made partner and has a long career ahead of them. And I think what we've seen in terms of development and nuance within, especially the women's health space, but other physician practice areas, is that the way rollover equity is handled can actually be nuanced. I think historically the approach was rolling equity into a national parent company where the idea is you have diversification of your risk, not necessarily just tied to your practice, but benefiting from where others can succeed under the larger umbrella. But I think now, and Andrea is probably best suited to discuss this given the strategy that they've undertaken at Women's Health USA, the potential of also having your equity sit at a local level, which has certain advantages as well. But Andrea, I'll let you speak to some of the nuances you've seen within your organization with regard to those two concepts.
Sure. As Women's Health USA looked to expand, and our strategy dates back to 2017 when we moved out west, as we looked at it, we felt there was going to be some strong value in really having our physicians be very tied to their own market and, really drive the growth in that market, because that would, and we structured the equity participation opportunity at the local level so that if the market was successful, the physicians would be as aligned with Women's Health USA in a joint venture model in a local MSO to be growing that market, whether we were talking about adding groups to the market, improving payer rates, adding ancillary services like mammography or lab. We created the equity opportunity at that local level. There was still an opportunity in our model, through a put right that allows them to participate in the larger liquidity event at the same implied multiple that WUSA would be selling at. But what it really did was have our doctors laser focused on their own market, which we knew they knew the best. When you sit down with physicians and you talk about, how do we grow? You don't get a lot of, silence in the room. The doctors know how to grow. What they lack is in many cases is the capital to do it, the risk tolerance to take on debt, and really the strategic analytics that are necessary to ensure that whatever opportunity they're choosing is the right opportunity. And, what we bring to the table when we speak to doctors is, look, everybody wants a lab, but you have to have enough volume to be able to drive into a lab. And volume comes from adding doctors. So who do we know in the market that we think would be a good fit to join our family? And, it takes some time. We've been working in most of our Western markets for several years, but we're starting to see the fruits of that labor with our doctors really aligned with us about what's going on in their market and actively bringing thoughts to the table that enhance the value of that local MSO that eventually will enhance that future liquidity event for them. So it's a bit of a different model. It takes, a bit more explaining at times, but I think it's a great opportunity and a great alternative to equity at the parent level, which is an equally strong model in terms of wealth creation and creating that second, third, fourth bite at the apple. I think both models have merit, which is why I think both models have succeeded in the market.
Yeah, that's great. And, the underpinning for all these different kind of structures that can be used is obviously the legal components of it. Even something as simple as the fact of, non-physician individuals being able to participate in the profitability of a physician practice, i.e. private equity groups, needs to be handled with care. And so groups like Justin's are particularly adept at making sure this is done in a cohesive manner. Would love to get your perspective, Justin, on how these deals are particularly structured from a legal perspective.
Yeah, and that's exactly right. Unlicensed individuals can't own medical practices because the laws in many states, the corporate practice of medicine law, and there's a similar type for each specialty, basically says that doctors need to be employed by professional entities or licensed individuals exclusively to ensure that they maintain control over clinical decision making. And so you might ask, well, how do I even do a deal with a private equity sponsor, and what are we talking about rollover if I can't sell the equity of my practice? And so what's really happening is that we've come up with a legal construct. Not McDermott lawyers came up with a legal construct whereby you look at any medical practice as really two businesses. There's the business of practicing medicine, and then the business of operating a business. And so there's a clinical side and a non-clinical side. And to do these transactions, we basically bifurcate the business into a clinical and non-clinical entity, and the non-clinical portion of that business becomes its own distinct entity, and that's the vehicle through which the private equity sponsor is able to make their investment. And you tie the fate of those two entities together with long-term management services agreements that ensure alignment of economics and value transfer from the practice after payment of physician compensation over to the MSO entity, which is where the physician rollover holders share in the growth of the business with their private equity sponsors. And so the legal structure on any transaction would be different based on if you're going to be the initial platform entity. And in that scenario, your business would basically be split in half into two businesses, your medical practice and your MSO, and the sponsor would buy into the MSO. And then if you're an add-on transaction, you're likely selling, the non-clinical assets of your business to the MSO that's already in existence. And so because of this legal structure that has to be observed or complied with, there are limited transaction structures that can be pursued, and that makes the tax status of your practice all the more important, and creates limitations on the types of transactions you can engage in, with partnerships being the LLCs that are taxed as partnerships being the most flexible, the ability to do a lot, S corps being quite a bit more limited because proceeds from a sale need to be distributed to all the owners equally. If you're a partnership, you can allocate proceeds differently, which is sometimes very important in some of these practices where it's made up of, it's an 8-person practice made up of 5 founders and 3 associates recently promoted to partner. Well, the founders who built the business over 20 years may be surprised to learn that they have to split the purchase price equally with their brand new associates who were promoted. So all of the legal structure impacts a lot of the flexibility in pursuing each type of transaction. And so we're going to get to key considerations in a little bit, and tax status is definitely a very key consideration.
I think, Justin, one of the things, as much as we might all groan about the complexity of the structure, I think as I take a step back and think about it from a business perspective, I think one of the things it's helped us to do is help physicians understand that what they're running is a business, and that, the practice of medicine is the clinical interaction with the patient, but it's also the business of their practice. And when we've done these, as you call it, the bifurcation of the practice into the business, it allows for more differentiated conversations that we're able to have about strategically where should the practice go. Not always clinically, what are you doing for your patient? Those conversations are equally important, but if you pull the two apart, you can have equally robust conversations about both. And that's really what has allowed us to help physicians think about, how do we move our practice forward? Not just how do we deliver good care and how do we kind of run in place, but how do we get it next level, which is what we spend a lot of our time on. So, as much as I would like to, sit and groan and kick and scream about CPOM and Stark and all of those things, I think it's really helpful as, we think about how do we grow in a market and how do we get the doctors really thinking about growth for growth's sake and what it will enhance from a clinical practice perspective.
Right. And just looping back to a comment AJ had made earlier, just around the seemingly competing interests in some regards of, older physicians within their practice versus soon to be partners or new partners and the various kind of outlooks they have and longevity in their careers. Dealing with those is always a unique and complex set of discussions that we deal with at the Providence side. Jake, if you wouldn't mind chiming in on that topic and just giving some color, I think that'd be helpful for those listening.
Yeah, of course. So we've seen several different methodologies to handle some of the retiring physicians and also to ensure that new associates who have a long tenure with the business going forward are adequately incentivized with the deal. And I think the typical things we see are from an allocation of cash at close to rollover equity perspective. What we generally see is for those retiring physicians who may not necessarily be contributing significantly to the growth of the business over that, call it 4 to 7 year horizon that the PE firm would be invested, those individuals are taking perhaps more cash at close, where the younger partners who have at least a second bite of the apple on the horizon and potentially a third or fourth down the road, those younger physicians would take a greater portion of equity as part of their overall purchase price allocation. And obviously one thing to consider with the help of people like Justin and MWE and other tax experts is just ensuring that that's all handled in a way that would be the most tax efficient and won't cause undue burden on the business going forward. And I would say on the other hand, from a new associate perspective, the individuals that may be coming into the business, at this unique and sensitive time, maybe they were offered a shareholder pathway in the past, or they may be a year out from receiving full shareholder status. Groups really need to reserve some portion of the proceeds of the deal to either bonus out these individuals or let them buy equity into the business. I think one thing, I think the crux of the discussion with the new associates or the new shareholder track physicians is allowing them to have some sort of win in the transaction. Again, whether that be a bonus at close or just having a clear pathway to equity ownership or profit share interest and shareholder capabilities in some way, shape, or form. Andrea, not sure if this rings true with kind of what you're thinking as well. You may be able to provide some additional insights on what you've seen in the past with, shareholders at varying stages in their careers in these transactions.
No, I think that is everything you said, honestly, Jake, rings true. I think, it is difficult in some of these transactions to, kind of parse through what everybody's, how to properly align everybody for the future and to properly create a strong liquidity event for those physicians that are looking and are much closer to retirement, while also preserving the opportunity for younger physicians to feel that they are aligned with the organization for the long term. And equity alignment is certainly, in my mind, one of the best ways to do that is if whether you align equity at a local or a national level, what we're really trying to do is to create that visionary glide path for younger physicians to see if I stay with this organization, there will be a future liquidity opportunity for me. The events that you do now generally are, will benefit the older physicians, but it's really, spending more time even in these transactions with younger physicians saying, yep, there's a lot of money coming in right now, but let me tell you about what we're going to do and how we're going to create wealth and value for you. And, beyond that, even just, that value, as I talk to younger and younger physicians, those coming out of residency, it's not necessarily, hey, come join our local group. It's, come join our local group. But, if you have an equity stake in the national organization and you decide, you get married and 3 years from now, your spouse has a wonderful opportunity in Las Vegas and you're sitting in Connecticut, you don't have to leave our organization. You don't have to give up that equity opportunity. We'll find you a place in, another part of our organization. And I think that's a message that's resonating as well with younger physicians. And that's what allows us to really grow and endure and create those opportunities beyond that initial liquidity event. I think I got a little off topic, but.
No, all important detail. And maybe setting aside the scenario where a physician's retiring at close, for those sticking around mid-career, certainly early career physicians, Andrea, being mindful of these concepts that are thrown about, certainly for those who haven't been through it, things like a management fee on an ongoing basis, but also the concept that there will be a compensation reduction to make these deals happen initially and create proceeds for the sellers. The idea and concept to be able to repair some of that income on a go-forward basis, the types of things that you and your partners bring to the table, albeit through the use of a management fee in some ways to facilitate. Could you give some color on those topics? Typically items that we hear some pushback or questions on the front end.
Sure. I mean, I think, in markets, particularly out west, the number one question that I get asked is, what are you going to do about my reimbursement rates? I don't get paid enough from, you name it, anybody in Buca, to be able to keep my lights on. So what are you going to do there? And I think, Unified Women's Health, Axia, we've all got teams of people where they are seasoned professionals that are working with the payers day in and day out to improve reimbursement rates, look for pay for quality programs, negotiate more sophisticated value-based care arrangements. That is one element of income repair. The other thing I think that we spend a lot of time on is ancillary revenues that I think Jake alluded to earlier in our conversation. Do we have enough volume to build a mammography center? Can that be inside of the practice? Do we need to feed it into a standalone location? What about a lab? Lab is one of those things where you stick it in a milk box and the revenue walks right out the door with the milk box. So, I think that is another opportunity that we work towards. And, really a lot of these value-based care arrangements, as they get more sophisticated, are going to create more income repair opportunities. I know we're running close on time and we could probably talk about this for, another 5 hours, but I think those are really the initial key things and the initial key levers that we're looking to move. I think the other last thing I will say on the expense side is, as you look at different platforms, your considerations also should go to, if you're looking at a national platform, they are likely to have national buying arrangements for things like IUDs, ultrasounds, other medical supplies, because there's only two ways to improve. You either grow your top line or you cut your expenses. And I think what Unified and Women's Health USA and my competitors offer is that opportunity to look for synergies on the expense side. Where else can we make your organization more effective? Can we come in and do, a consultative evaluation of what's going on in your particular care center to say, you could run more efficiently with one less MA. You don't have to do it, but here's some ideas on how to make yourself more efficient. Bring in more mid-levels to your practice, leverage yourself better. There's a myriad ways that we look at income repair, and we're trying to describe all of these things because you are right. That is the element that we utilize, right, to create purchase prices is comp reduction.
Yeah, exactly. And we spent a lot of time talking through the ramifications of a deal, what to expect and the like. But for people who are prospective sellers and thinking themselves, how do I ensure I'm maximizing value before any of these things take place? I think it'd be good to spend some time on sort of the preparatory phase of the process. With that in mind, Justin, what can you share with us, whether it's structurally related or otherwise, as to what you would suggest groups do?
Yeah, absolutely. Number one, probably engage an investment banker, probably Provident. No, but you definitely want to team up with an investment banker and a law firm early. You may think that you can represent your own interests better than anyone else, and that you maybe don't know everything about transactions yet, but you can figure it out as you go. But I promise you that this is a game of experience, and a lot of times you don't even know, you really won't know what to ask for, and you haven't seen 100 transactions, seen all the different requests made and how they've been responded to by the potential buyer. And so I think that one, getting your third party advisors in place as early as possible makes a lot of sense, and they'll help you guide you through the process. And when we talk about a process, I think we're talking about, going out to market, searching for a buyer, maybe having, an auction process run on your behalf. But a couple other considerations that are top of mind are to think through the leadership and approval process within the practice. If you're a 10-person practice, the buyer's not going to want to negotiate with 10 people. Maybe you make a subcommittee. To some extent, the buyer is going to want one person who's going to have legal authority to make decisions on behalf of the group at the closing and soon thereafter, in connection with certain things that happen in these transactions. And so you might want to think about who's the person that'll best represent our interests, and make them, give them authority to negotiate on behalf of the group, subject, to bringing everything back to the group and debriefing them. So the buyer has one person that it's talking to, and then the seller rep is coordinating with the group to make joint decisions. We talked about distributing proceeds. Think about your tax status. You're going to want to understand how that's going to impact the transaction, both the structure and the ability to distribute proceeds in a manner that you think is fair among the partners. For example, if you're a C corp and you need to do an asset deal, because the buyer, again, can't buy the equity of your medical practice, so you'll want to know in advance, like, is a personal goodwill sale viable for me, so that I can save money on taxes and pursue the most tax efficient structure, and if not, what are my other options in order to mitigate that additional tax burden that specifically falls on C corps due to the double layer of tax. You definitely want to think about retirements, because the sponsor is valuing your business based on future income, future cash flow streams. And so you don't want to tell the buyer that the week before closing that your two biggest producers actually want to retire in 3 years. That's a complete change of the deal.
Please don't say that.
Andrea,
Yeah.
I'm sure. But how are you going to handle your partner track associates, or you have your partner track associates and maybe some other associates? How are you going to handle all of them? And probably especially the partner track ones, make sure they get value and they're taken into account in these transactions, because they're probably driving a substantial portion of the purchase price of the business as well, or they might be. And in that instance, they may have some holdup value. And so you don't want to find out that they have holdup value when you get close to the closing and the buyer's tells you to go ask them to sign their new employment agreement. We don't want to do this deal. So I think, last and is maybe, from a legal perspective, get your house in order, especially your cap table and your shareholder charter, and understand who owns the business, who's legally entitled to participate in this transaction, who's legally entitled to sign off on the transaction, because all of this is going to factor into the how smooth your transaction process is going to run.
And I will say from my perspective, we really do want sellers to be to be properly represented. I want everybody that we're doing business with to understand the transaction. These are complex. And, the worst case scenario for me is a physician feels that, this isn't what they signed up for because they didn't understand it at the front end. This is not a time, particularly in a platform liquidity event, to be penny wise. You need, strong advisors that are going to say, yep, this is how these things are done. I know it's complex, but let me break it down for you. Because the worst thing for me is to have a bunch of physicians that didn't understand what they were getting into, because then they're mad at me forever. And, our goal is to create a sustainable and enduring partnership. And that starts with intellect and understanding about what you're stepping into, eyes wide open. So I couldn't agree with you more, Justin, in terms of finding the right, both, legal and business counsel to really get you through a transaction, eyes wide open. Every partner that signs on the dotted line gets it. So that when when we walk in the next day after we close, after everybody's put their money away, and we say, let's get going, giddy up, everybody goes, all right, I get it. Let's do it. How do we grow?
Yeah, we appreciate that. And, one concept we've thrown around a lot today, which on the surface can be a little daunting to a prospective seller, the idea of a compensation reduction. That's never a good term in people's mind, but obviously it's it belies the actual valuation and ability to transact. Always a hot button issue and something we deal with heavily on the front end in Provident's role. AJ, if you give us a feel for the different options on that front, what we've seen, what sellers could expect, I think some framework on that would be very helpful for prospective sellers.
Definitely. And I think this really plays a key role in a practice's preparation to go through a process like this. For context, most physician practices end up distributing the profit of the business at year end to the physician shareholders to create kind of a net zero balance. So in order to create profitability on paper that a potential private equity firm or strategic partner would acquire, it requires the physician shareholders to sell some of their equity in order to create that profitability stream that would be acquired in exchange for cash and stock. What we tend to see in OBGYN is that there isn't necessarily an industry standard comp model. And in fact, there could be variations across divisions within a given practice. So practice A might have 3 divisions. One may do RVU basis. The second may be doing salary only, and the third productivity model. So what we've seen as kind of a solve across the board is the concept of doing an income scrape or a remittance. So typically, physician shareholders will sell a portion of their income to fund the EBITDA or profitability that a potential partner would be acquiring. And that can be expressed a number of different ways. Oftentimes you see it as a strategic fee or a management fee that's pegged to a percentage of revenue going forward. But the idea is to create a situation where the private equity firm or the strategic partner can access that income stream that they acquired, while still preserving optionality for the physician group to structure compensation in the way that best allows them to be successful at the local level and compete with other groups in the market for new recruits, as well as serve as kind of a sustainable compensation model going forward. And really, sustainability is key, and what we encourage all of our clients to think about when they go through a process like this. Some groups, the knee-jerk reaction would be to sell as much compensation as possible because that creates more enterprise value that you get a multiple on. But it's important to consider what that future looks like if you've sold the majority of compensation in the business and you're way below market. It's going to be difficult to keep those physicians incentivized to continue producing at the same levels as they were pre-transaction. At the same time, the other end of the spectrum is a knee-jerk reaction to sell no compensation and preserve as much compensation in the pool as possible. But then again, what's really the rationale for going through this transaction process if the dollars and cents aren't meaningful enough to go through the transaction process as a whole? So there really does tend to be a fine balance of guiding around a normalized compensation or compensation pool that not only kind of maximizes the outcome of the transaction at closing, but still creates sustainability for the long term, not just for the physician shareholders, but it's in the best interest of the private equity partner and strategic partner as well.
Great. And, very next question out of a prospective seller's mouth and mind would be on the employment agreement side. Justin, anything quickly on that topic you'd like to share in terms of expectations for those people?
I mean, as AJ mentioned, the value of the business is derived from future collections, which are the services performed by these physicians. And so in order to come up with a purchase price, you almost have to simultaneously come up with a go-forward compensation methodology. And that varies depending on how the financial sponsor has underwritten the business. And I think there's a few different types of ways a management fee can be cut and derived that will affect physician and private equity alignment after the closing. And they each have their pros and cons. One being, a physician compensation pool that's structured after a top line revenue scrape, model, which would basically mean that all the money after taking off the management company's fee is left behind for the physicians, and physicians might like that because there's much less control or influence by the private equity sponsor on incurring various expenses, right? If a physician wants to make an investment, they can do so because it doesn't affect the private equity sponsor's management fee. And so that type of model comes with more physician autonomy, but then also more risk on more financial risk on the physicians in making those types of decisions. And there's kind of a profit sharing model that I think Andrea can probably speak to best, that basically ensures that the physicians and the private equity sponsors are aligned on both the top line and the bottom line, and allows and changes the influence and the coordination between the clinical side and non-clinical side of the business. I think maybe Andrea, we were talking about that the other day. You could probably speak best to this.
Yeah, I mean, I think sort of the compensation from personally performed services is one thing that will get sorted out in the transaction. Most of our groups use a revenue minus expense or eat what you treat model, which is your top line minus your expenses. What falls out to your care center is what you take home. But we then kind of further bifurcate out what's going on from a growth perspective. So where are the new revenue streams coming in? And in our model, we are sharing those dollars with our doctors so that we're both, sitting at the table going, what's good for you is good for us. And, you run into issues sometimes, with doctors, even when you open your own lab and all that revenue is going to come into the practice, there are still doctors that, well, I always put it in the LabCorp milk box, the Quest milk box. That's what I'm going to continue to do. But when you sit down and you have a conversation, you say, look, this is our lab. If we take 100 cents of every dollar that comes in and we share that, we're both succeeding. This isn't me taking more than you or you taking more than me. This is us looking at this going, yes, we're both committed to this opportunity. That allows me as your capital partner to invest the capital necessary to build that structure out. And, with the assurance that, if I build it, we will all come together and utilize it. And I think, for us, it's a winning formula, and it keeps our doctors aligned both with what's going on in their care center to improve their own productivity, but also to look at the larger picture of those strategic initiatives that we're looking at in market and how we can both benefit from that.
Thanks for those comments, Andrea. And realize we're running a little bit long for the allotted time. So I think, in conclusion, we are collectively here quite confident in the ability for ongoing consolidation, not only from the perspective that the financial implications and wherewithal to have those completed is certainly there, whether that be interested parties from the private equity side, the lenders that fuel those transactions, and so on and so forth. But just the sheer amount of opportunities that are out there, practices like Andrea's told us about that seemingly, want to get back to concentrating medicine and not the day-to-day operational components that have really probably taken over their lives at a certain point of their career. So we're very bullish on that potential. We see the development of continued kind of private equity platforms driving consolidation, along with some consolidation of the consolidators, as we call it, a transaction like Andrea's group recently went through. As time goes on, we see that extending to the subspecialty focus we've talked about, whether that be standalone specialty-specific platforms or just through the proliferation of groups like Andrea's that develop into value-based care, one-stop shop, women's health platforms. All of those are things we see coming to fruition in the coming years. And myself, Justin, his team, and certainly Andrea, as a consolidator in the space, are looking forward to facilitating those deals moving forward. We appreciate everyone's participation today. Andrea, thank you very much. Justin, thank you. If there's any questions, certainly reach out to any of the panelists. Our contact information was on the initial outreach for the webinar, and we look forward to hearing from you. Thank you.
Thanks.
Good day.